Welcome to On the Beat, everyone. I'm Troy Thompson. Joining me in the studio today is Jeff Farnham with JTS and Company Mortgage Professionals. Today we're talking all about credit tips. Welcome to the show, my friend.
Glad to be here. Super
important. I'm going through the process right now back home in Atlanta about getting my credit checked for if I decide to buy a home or if I'm pre-approved.
Right.
It's very stressful. So what I decided to do was send out an email to all of our viewers and find out what they wanted to know. So you ready to be put in the hot seat?
Absolutely.
Okay, one of our viewers wrote in, when building, maintaining a good credit score, how does my payment history affect my score?
A lot of things go into the credit score, payment history being one of them. You know, one of the things that looks back 12 months, 24 months, 36, 48, over the lifetime of that loan. Did you have any late payments? Did you not pay it on time? Right? And the question is, was it over 30 days late? Credit cards have a cutoff date. It's due by the 5th. If it's paid at 12/01 on the 6th, right?
Yep.
It's late, 30 days late. Installment loans have a due date of, say, the 5th, but maybe there's a 10 or 15-day grace period.
Got you.
So if you pay it within the grace period, that's not going to negatively affect your credit score.
Okay.
But if you pay it on the 5th of the following month or the 6th of the following month, you're over 30 days late, and that can have a big impact depending on how many you have.
I see a lot of commercials on TV called debt consolidation, okay? Whether you're putting all your credit card debts onto one, or you see these companies that do it and they try to negotiate on your behalf.
Right.
Is that good for, because that drops your credit score?
Well, it may or it may not, right? There's lots of factors, and really when you're talking about credit scores and you're doing credit repair, you really you need to interview who you're going to work with. You need to sit down with, make sure the people you're dealing with have your best interests at heart.
Right.
Understand all the ramifications. 'Cause a lot of people go in, they'll consolidate all their debt, they've got 6, 7 credit cards, they consolidate it all into one note and close all those accounts out. That actually could hurt your credit score, right? Because your available credit has been diminished, right? So you have to be careful with what you're doing. And people, they get advice from friends, they get advice over here, and they don't know what they're doing. And they thought they were doing right. It made sense.
Yeah. Right,
but they actually hurt themselves. You have to be very careful when it comes to trying to improve your credit score.
I got you. All right. What is a credit inquiry and how does it affect my home?
Yeah. So anytime you go in to apply for a loan, they're going to check your credit. When you go to borrow money, a credit card, a car, a mortgage, a finance company, a student loan, they're going to look at your credit, right? That's called a hard inquiry. And if you have too many hard inquiries in a short period of time, that can negatively impact your credit score. So when you're looking at the different types of loans, on your government-insured loans, the range of credit score where it impacts your rate is much broader.
Right.
On the conventional loan, there's many more tiers. So what happens is, if you go from a 740 credit score to a 720, you're going to be in a situation where your credit score might not be as strong as it was when you were a 740. Right. So you want to be careful. If you know that you're, especially a major purchase, right, that you're going into, you know that in advance. People don't walk up there and say, I'm going to go buy a house today. It's usually a 30-day, 60-day, 90, maybe a year-long process.
Right.
So in preparation for that, minimize the credit inquiries.
Right? Got you.
Don't let, if you go shop for a car, one of the worst things we see that people go from car lot to car lot to car lot over a period of 3 or 4 weeks, and every one of them has pulled their credit 3, 4, 5 times.
Pinged you.
Right. Be careful.
Right. Something interesting. I like this one. What is a credit utilization ratio, and what should that ratio be?
Right. All right. So that goes back to the conversation we were having just a minute ago with closing out all those credit cards. A credit utilization ratio is how much credit do I have available to me? Do I have one credit card with a $5,000 limit?
Right.
Do I have 2 credit cards and that totals $15,000, $10,000? Wherever that number is, that's how much credit I have available to me. Somebody that has that maxed out, let's say they've got $1,000 in available credit, if they owe $900, even with a perfect pay history, that's going to bring their credit score down, as opposed to someone that owes $300.
Got you.
We feel like 30% utilization is going to give you the maximum impact to your credit score, right?
I got you.
Yeah.
Buddy, gosh, you give us great information.
Yeah.
You really do. It's really great. If you want to find out more about Jeff and his incredible business, there it all is up on the screen. JTS and Company Mortgage Professionals. Back after this short break.